Rolls-Royce stock is up 300% in the last 12 months. What the heck is going on? I saw this from a review and I couldn't believe it. I have to do a review right now on Rolls-Royce. Am I traveling? Yes. Is it way too late to start a video? Absolutely. Am I going to do it anyways? Let's do it. Also, special surprise, I'm going to do this live with the screen record so you can see exactly how I build my cash flow one-pagers. It's going to be a little rough because I'm just on location working on a laptop, but we're going to get it done. You ready? Let's get to work. Welcome to Rational Investing on the road, doing a video from my hotel room in the great city of New York. Let's get this done. The first things first, this channel, Rational Investing, what is it about? It's about rational investing, obviously. But we look for cash flow and we are equity buyers. We want to see lots of cash, growing cash. And then we buy those and hold those for a decade, 2 decades, as long as you can, as long as the business continues to grow and compound. We don't sell, because when you sell, you pay taxes. When you pay taxes, you start at a lower dollar amount and your money has to work even harder. The best investors make one decision and hang on to it for 30 years. Here we go. What we're going to do is we're going to go through the 5 key attributes that we use in this channel to review each stock. This one's going to be Rolls-Royce. We look for top line revenue growth, earnings growth, EBITDA growth. We look at strong free cash flow, low debt, and a well-priced stock. Those 5 things is kind of the beginning for us to begin due diligence to look through an investment and see if it really checks a lot more boxes. But that at least is the first take. All right, so the first thing I want to do is I'm just going to pull up Rolls-Royce because I know honestly nothing about the company. So this is a first cut, and forgive me, everything I discuss is going to be in British pounds. I'm so used to saying dollars, I'm probably going to screw up. Bear with me. Also, I don't know a tremendous amount about their strategy, so I'm basically going to run through the numbers and say what the numbers say. I will leave it up to you to judge, is the forecast accurate for the long-term vision of the company? But let's take a look at Rolls-Royce. Obviously, I think about the car, the first thing I think about, but this company actually makes a whole lot more. In fact, this company doesn't even make the cars, from what I can tell. It is all engines, airplanes, motors, aero defense. They are the turbine jet engines. They are the boat motorcraft engines that are in monster trucks, monster ships. This is the material that they actually make, not the car, which I believe is owned by, you guys are gonna kill me, might be out Volkswagen. I can't remember if that's Bugatti or not, but I think this company is just the automotive engines. Excuse me, the airplane engines. So midterm targets. I'm looking on the website. Very first thing, 2023 full year results is down here. We've got operating profit 2.5 billion to 2.8 billion. That's the guidance. 13 to 15% operating margin. Free cash flow, you gotta love that, guys. Free cash flow 2.8 to 3 billion dollars is their guidance, and a return on capital 16 to 18%. Now, what do I always say? Businesses that don't have revenue talk about customers, they talk about total addressable market. Businesses that have revenue but are not profitable talk about revenue, they talk about transactions and customers. Companies that are profitable but have negative cash flow talk about profits. This company is talking about cash flow. That's what you want. You want a business that's talking cash flow, leverage, and customers. But they've got to mention it and they got to bring it up at the top and make it a forefront of the conversation. These guys do not only free cash flow, but then return on capital right there at their targets. I love seeing that. Some resources here, results, presentations. Let's take a look at the presentations. Dive into see if they got an investor presentation, PDF. Let's pick this up and kind of comb through it quickly just to get a feel for how they present the data, how forthright are they with some of this material. So page 1, looks like we've got an outline here, fine. Diving in, let's see, differentiated groups, strengthened through transformation. Interesting, so they've gone through some sort of evolution. Here we go, civil aerospace, excuse me, defense, power systems, nuclear in the group. Okay, so no automotive, no car here. There's definitely something different. These are the different facets. Look at that bad boy right there. Fantastic that they make. Let's see if we got some, here we go, some numbers over time, 2022, 23, 24. 24 is not done yet, so they've kind of clouded it. And they're saying, hey, midterm target, this is where they got the 2.5 billion pounds. So it looks like last year they did 1.6 billion. That's up strongly from 650 million. Very interesting. Operating margins are growing, free cash flow is growing, return on capital is growing. That's nice to see. Let's see what it looks like more historically. So this might be your 3 reporting segments: capturing performance, improvements, opportunities, civil air defense, civil aerospace, 11.6%. This is profit, defense, and power systems. Okay, targeting mid-teens long-term for all 3. That's very decent. Let's see if we can skip through. I'll let you guys dig deep into this. I'm not going to do a deep dive into every single slide here. Here we go. This is group profit improvement from 2022 to 2023. It looks like the civil aerospace grew dramatically in terms of profit. Most of the year-over-year step up is actually this group. Defense and power systems make up substantially less improvement. So here they have the full year operating results. Really high level here. Revenue, 15.4 billion pounds. We got gross profit, is profitable gross margin, operating profit, 1.6 billion, up a lot over last year, 147.3%. That's probably where the strong stock market growth is coming from. And then the profit after tax, cash flow, positive cash flow in both years, very good. Net debt, must be pay down of debt, or are they actually debt free? I mean, net debt is typically total debt minus cash. So this could mean actually that they have no debt. This is very interesting. We'll have to check that. And return on capital, 13%. Then they break it up into the individual business units. I'll leave that to you to review. Cash flow bridge, okay. Working capital, fine. I don't see any share-based compensation here. That could be interesting, okay. Let's see what else we get. Financials. Sorry, just skipping through. I'm looking for a full P&L if they put it in here. How long is this? 81 pages. Whew. They go all out, don't they? All right, so here we go. Financial results summary. I have a trend here since 2019 to 2023. It looks like underlying revenue basically rebounded. In 2019, it was 15 billion, then 11.10. So two years in a row of declines over a 3-year period. Then it turns around to then 12 and to 15.4. So definitely a dip. Probably a COVID kind of order cut reduction, which led to losses, and that rebounding is happening right now. So it looks like the stock is probably returning back to what it once was. Profits, midterm. I don't see any debt levels here. Okay, so we know one thing is the growth seems to be rebounding to what it once was. Let's go take a look at all 10 years of data and see if that tells us a better picture. We have guidance here that they are going to grow, but the growth recently is not going to continue. They're going to be back towards a mid-teens operating margin, and they're going to kind of level off a little bit higher than where they are currently. All right, so here we are with the cash flow one pager. The very first thing we do is, go get the financial statements. I'm gonna pull up our balance sheet, and what I'm gonna do is I'm just gonna move this over into my model so that I can easily adjust it. I'm gonna go get the cash flow statement now, and I'll move that into our model, label that as my cash flow statement. And I'm going to get the income statement, and I'm going to move that over into my model. So I've got all 3 statements, in over labeled, so it's easy to maneuver. And I highly recommend at this moment that if you want to learn how to do this and how to be fast, you take my course on financial modeling. I'll teach you how to model like an investment banker. I'll give you the keystrokes so you don't need a mouse to do this, and you will be fast. The reason you want to be fast is that when you're fast, you can look at a whole lot more companies than you otherwise would have. and that will speed things along. The more companies you look at, the more options you have, the better you're going to be when you start looking at companies to put your money in. So we just picked up revenue. We're going to pick up EBITDA here. I need to get shares, and fully diluted weighted averages. This is fully diluted shares. Oof, look at that share issuance. Whoa, something definitely happened there. That's incredible. Huge dilution with revenue that was actually down during the same period in earnings. That's interesting. That's going to take a little bit more discovery on our part. Let's go look at the cash flow, pull the cash flow for what we need. There are lots of places you can get the data for companies that you want, but having it organized the way you want to see it is not always easy. If you know shortcuts for investment banking or being able to drive Excel without a mouse, you will be able to do it much faster. And like I said, you can look at more stocks. You can obviously automate the process. Lots of people do it. The reason I don't automate the process is because every company is slightly different, and going through the process of looking at the data, just like I saw with these shares, you will pick out things that you're going to want to go back and look at. And unfortunately, there's no simple solution. You got to kind of do the work. That's just the way life rolls. So let's pick up our debt payments. They were buying back some stock. Looks like they paid off a tremendous amount of debt over the last several years. So I'm curious to see what their total debt balance is when this is all said and done, and if their net cash position is truly positive. Let's go find debt. Let's go to our balance sheet now. So we're almost done filling in the data. They don't really have any short-term cash, so yeah, they kind of do. So even though they have no short-term cash here, they have 3.7 billion of cash on hand. So what I'll probably do is pick like a $2 billion number, and I'll up that to I'll do 1 billion, and I'll up that to like 1.5 billion of what I would consider excess. That should be here, get them through the tough times. And so what's left, excuse me, so I said that the wrong way. So this 1 billion and 1.5 billion would be the amount of cash that they need to have on the balance sheet. And what I just put on off the side would be the excess that you could run this business with, having not had that, being missing $1 billion here. They never come close to touching this billion, so you could literally kick out $1 billion and you wouldn't even notice it. So I would consider some of that excess cash. Let's go take a look at the total debt that they have. Take a look at total leverage. So total debt, let's see, long-term debt, sure. So they have debt, current portion, current borrowing, short-term borrowing, current portion right here. And then we want long-term, and any capital leases is right there. So yeah, they definitely have debt. I'm not sure what that page was talking about with negative net debt. Maybe that was probably cash flow, what they paid out in that period, paying down debt. It was not total debt, because their total debt, if I net these two, is about $3 billion, 3.5 billion. All right, market cap. We need the stock price. Let's go find that. Good old Yahoo Finance. Let's go back and see Yahoo Finance. This is in Great British Pounds. Let's go find historical data. Let's get, I want the monthly average, and I'm gonna go back as far as I can. I'll download that, open that up, and we're gonna drop this in to start shaping. So wow, stock data all the way back to 1988. Let's go pop this into our handy dandy chart. So we're going to grab all that data, and we want the pricing, the closing price, And we're gonna bring that data all the way up there. And their fiscal year, ooh, where is their fiscal year? Let's go back to the top of this 80 some odd page Goliath. Let's go back to the IR page. Assets, December. December is year end. Okay, so these numbers are 12/31/2014. Probably a little too early, but we'll check. All right, this is 2014 is the first price I want. So 2014, I guessed right. Bingo, done. Again, these are, I'll change just this one, but it's all in pounds, not dollars. Okay, now that we have the stock prices dropped in, I need to give you a quick reminder that all the stock pricing in the LSE stock is not in pounds. To get pounds, you have to divide by 100. So we're going to divide by 100, and we should get what we're looking for. So 100, we're going to take all these pricings, we're going to divide them to get pounds, and there we go. That should give us £3 per share per share price is the share price we want. On the stock market in the London exchange, it's at 412, which to get pounds, it's £4.12. Pence. So that foots to what we're trying to do. And now let's continue on with the rest of the build. Okay, now that you have everything together, let's sit back and see, what do we learn? What do we learn here? Well, it looks like revenue is growing about 2% over this decade. If I shorten this and look at pre-pandemic levels, that's a 4% growth rate. If I do cash flow 12, that seems oddly high. And if I do earnings, that's negative. So it looks to me like this company's done a little bit of a round trip with small growth on revenue, cash flow, and EBITDA of a low single-digit range. 2 to 4%, someplace in there would be a conservative growth rate for this stock. Debt levels grown fast from 2.3 to 5.8 billion pounds. And then excess cash has also grown nicely, offsetting some of the debt, but the debt has obviously gone higher. Market cap, 5 billion pounds, or 5.5 billion pounds to 25 billion pounds, again at the £3 amount. It's trading now at 412. So it's definitely come up above the December number. We're now in April filming, so it continues to rip higher as revenue, earnings, and margin and cash flow return. Leverage is 1.5x. It's a good leverage number. Enterprise value 12.4. That is a decent value for a business that has low to single digit growth prospects. Let's look at cash flow. So cash flow here, is growing slightly, is growing slightly, 7%. Like I said before, kind of in that 2 to 4% range. Depends if we peg, like, maybe this number's a little low, maybe this number's a little high, and that affects the price, the ratio or the percentage. CapEx is affordable. They put 429 billion pounds back into the business last year. They could easily afford it with 2.4 billion pounds of cash flow. I think I said that's 439 million pounds. They paid down debt for a free cash flow of 1.7 billion. Let's check this for a second. I want to see what this equals. So if I just look at if I just look at cash flow for a second, so billion pounds annually, and I take that and divide it by price, or per share rather, I get a per share basis. So their debt has paid down. They don't need to pay debt anymore. So you can unlock all that free cash flow for the shareholders. So they're at almost 2 billion pounds of free cash flow, or 24 pence per share. Let's put this into a forecast and see what we get, okay? So we'll come out here. We're gonna pick up from last year. I'll leave the 3%, that's fine. I'm not gonna do much of a market multiple expansion. I'll leave it at 13. It's at 12.4 now, probably actually a little high of that because the stock has continued to rip. I'll leave the rest here. I got a forecast. Let's take a look at this number. This is gonna be the free cash flow without the debt payment. And I'm gonna grow that by my growth rate here. And I need to apply a yield to it. Probably a 7% yield. It's probably fair. So it looks like average stock price, 455 pence is what it should be. It's $4.55. Let's take a look again. This is all in pounds, even though it says dollars. I'm just using the sheet. I haven't actually gone back and done it all. Where's my pounds? I always miss it. There we go. Okay, let's go find the stock prices. At the current stock price is 412. This is minus 412. The stock price, stock IRR with this forecast, and I'll let you guys decide if this forecast is too conservative or not. I'll do some variant sensitivity analysis in a second. Actually, we can do it. This is 4.12, and this is pounds again. Let's see if I don't miss it this time. I missed it again. There it is. That's too hard to see. But basically, £4, 9% IRR is the rating for this stock at its current level. So what I think is going on here is the order book for this company has returned. Margins are back up. Revenue is a spike over last year because it was so repressed. Earnings have come back, cash flow, and they've paid down debt, which is all great signs. I think the stock is fully valued if you assume long-term 3% annual growth rate, which is what they've been doing kind of long-term, even before the COVID drop. So I think you're going to have to assume, let's do a 5% annual growth rate. If I do a 5%, okay. So if I do a 5% annual growth rate over the next decade, then it's a winning stock. If you think it's 3% or lower, I'd wait. 5% or higher, it's a win. This has been a review on the road from the Great Big Apple. Let me know what you think on this review. Throw me a link down below. Throw me a comment. Let me know what stock you want to do. This person responded to an email from the Cash Flow Club. I thought, let's dive in it. Let's do Rolls-Royce. It's way too late for me. I'm still up. I got a big meeting tomorrow, but I love looking at stocks. Let's do this. All right, let's wrap up our Rolls-Royce video. Let's review the 5 key attributes. Number 1, top line revenue growth. Yes, it's growing. Number 2, earnings. Yeah, they're growing. Number 3, cash flow. Yes, it's there. They can pay the capex. Number 4, low debt. Yeah, it's 1.5 times. Number 5 is well priced. I'll leave that to you. I'm gonna leave that as an open circle. I don't know what to do there. If you assume 3%, it's kind of at market. If you get a little bump, it becomes above market, which is a good buy. So I'll leave it to the viewer to figure out if you want to dive into Rolls-Royce and be a tremendous player in the huge aerospace, marine, and defense engine business. My name is Cameron Stewart, CFA. This is a stock review on the road from the Cash Flow Club and the Rational Investing YouTube channel. Like I said earlier, throw me a comment down below. It helps the algorithm. Share this on social media. I appreciate the support, and I will catch you guys next week. Bye-bye.